Welcome to My Game is Money Investing with your host, Mr. G, the retail trader. First, I'd like to thank you for visiting the channel, as of course your presence is always appreciated. Today's episode is stock lingo and some phrases that you have a better understanding once I provide some definitions. So, swing trading, which is my strategy. Swing trading is a style of trading that attempts to capture a short to medium term gain in the stock market or any financial instrument over a period of a few days or several weeks. Swing traders primarily use technical analysis to look for trading opportunities. So, it's a lot like day trading, except a slightly longer time frame. After each buy and sell cycle, your slate is clean with no carryover. Now, there's another strategy called quantitative traders, or quant for short. They use mathematical models and large data sets to identify trading opportunities and buy and sell securities. So, there are different types of investors, different types of strategies. This, the quant strategy, typically use AI to gather information to make calculated decisions on stock picks. A whale. This term you'll hear in some analysts and reporters and some articles. You'll even hear it on fellow YouTubers who will describe whales as any individual or company that has enough money and power to directly influence the price of cryptocurrency or stock, usually in a negative way. Think of a whale as a large mass that can make a large splash. And the same concept can be applied to crypto and financial markets. Baked in. This is also a term you'll hear on CNBC. You'll hear it in articles, or you'll read it in articles, and you'll find quite a few commentators use that phrase quite a bit. It is commonly used investment phrase that refers to the ingredients or assumptions that go into a stock price. For example, company ABC is trading at 100 times earnings. It looks like the sales growth is baked in. Or XYZ had an awful earnings report, but the stock went up. These are just a few examples of what the phrase baked in means. Averaging up. Averaging up in a stock increases your average price per share. For example, say you buy XYZ at $20 per share, and as the stock rises, you buy equal amounts at $24, $28, and $32 per share. This will bring your average purchase price at $26 per share. So that's just an example of averaging up. There's also a strategy called averaging down. Is an investment strategy that involves a stock owner purchasing additional shares of a previously initiated investment after the price has dropped. The result of this second purchase is a decrease in average price at which the investor purchased the stock. It may contrast with it. It may be contrast with averaging up. So basically, it's the opposite of averaging up. So tailwinds and headwinds. You'll hear this quite a bit. Tailwinds are factors and events that help increase growth or cause positive effects on profit and revenue. Now, on the other hand, headwinds are factors or events that slow down growth or cause negative effect on profit and revenue. A headwind from one sector can be a tailwind for another sector, and vice versa. I'll even use an example. So, we're all dealing with fuel costs being on the rise. Now, same applies to the Carnival Cruise Line or the cruise line itself industry, and also the airline industry. So, because the cost of fuel is going up, those are affecting the price of, let's say, cruise liners and airlines. Now, it's also having a positive effect on crude oil. And of course, that's where these sectors are vice versa, with the positive and negative. Another word you'll hear quite a bit will be diversification. Diversification is the practice of spreading your investments around so that your exposure to one type of asset is limited. This practice is designed to help reduce the volatility of your portfolio over time. I personally don't use diversification enough. It's not part of my current strategy. It may be part of yours. Like I said, I'm mainly going to focus on my swing trade strategy and share, what's going on currently with me. That's what I'll be doing with this channel. A consensus estimate. A consensus estimate is a forecast of a public company projected earnings based on the combined estimates of all equity analysis that cover the stock. Generally, analysis predict a company's earnings per share and revenue numbers for the quarter and fiscal year, and also the future fiscal year. So these are, analysis and or analysts who help provide their insight as to what they believe will happen to the stock to generate your assistance that you'll need to make an investment. This wraps up today's episode. I hope you enjoyed it. I hope you got some insight on some much needed content as it relates to some definitions and phrases that you need and you hear throughout the networks and on the articles. Please hit the like, subscribe, notification bell, and leave a comment. Always enjoy reading the comments, and of course, constructive criticism is welcomed. Again, thank you for spending time with me today, and you have a good day.